Welcome back to the Costing and Pricing Learning Program. My name is David Gilchrist and I'm here to present Webinar 2 in our webinar series entitled Introducing Costing and Pricing. Before we get into the main part of the presentation though, I would like to just stress the copyright rules in relation to this webinar, and so that if you intend to use this webinar for group presentations or under any arrangements, please refer to the website in order to ensure you understand the copyright requirements of these materials. I'd also like to just confirm the navigation. You're at webinar 2 in this webinar series. So the last webinar was an introduction to the materials, and the next webinar will be an extension of the introduction to costing and pricing, where we look at costing and pricing practice. In this webinar, however, we're looking at costing and pricing in general. We're going to introduce people with limited costing and pricing experience, an overview of the key elements of costing and pricing, and to help prepare people for the webinars to come. Even if you have experience of costing and pricing, you're an accountant or someone that's worked in the sector before looking at the financial sustainability of your organisation, we think it's still worthwhile you looking at these introductory webinars to ensure that you understand the basics of costing and pricing before you move on to the more substantial material. In any case, in this webinar, we're going to look at some general comments around costing and pricing, have an introduction to activity-based costing, which is the fundamental costing and pricing technique we're looking to use throughout these materials, to look at some of the decisions to make before you undertake costing and pricing, and also look at some of the sources of data and strategies around costing and pricing that might be relevant to you. We'll also look at some processes around identifying activities into the costing and pricing process. So let's get on to the first element, which is some general ideas on costing and pricing. Firstly, in terms of human services in Australia, most disability service providers have operated in an environment where the state or territory government has set the scene as a result of funding arrangements. Traditionally, the funder has set what can be called business rules, and those business rules developed over time to prescribe what money could be used for and what services were to be provided to whom. This meant that many organisations have never costed and priced before, or where they have, the process was developed in the context of business rules and not really aimed at understanding the true cost of service delivery or the gap between the true cost and the funding received. With the advent of person-centred care and individualised funding policies, including the NDIS, the need for costing and pricing has become great. We would argue that even if the NDIS didn't come to the fore, it would be necessary for organisations to undertake costing and pricing, because that's the only way they can really appreciate the extent to which they're financially sustainable into the medium and longer term. Therefore, this particular program looks at that financial sustainability in broader terms, and in today's webinar we're looking at costing and pricing of human services in the context of increasing understanding, building better communications within your organisation, better decision making, better risk analysis, and also better mission focus. All things that we believe will extend your sustainability into the medium and longer term. The other fundamental aspect that we want to look at is the idea of the target price gap. Overall, the purpose of costing and pricing is to enable an organisation to understand the difference between its optimal price, what we call the target price, and the actual price it receives. We call this the achieved price. In the case of disability services costing and pricing, we're concerned with our calculated target price, which includes all costs being recovered and a margin. We're talking about margins in a later webinar, but it's sufficient to say at this stage of the game that a margin, of course, is necessary in order to ensure not only you're recovering your current costs, but also you're able to move forward to be able to present your price in a way that allows you to recover your assets and replace your assets in due course. It could also be the achieved price received from any state or Commonwealth agency, or indeed any price paid by a customer for purchases that you might provide. However, generally speaking, we call the achieved price that price offered by the NDIA for services rendered. The difference between the target price and the achieved price is the target price gap. We make this calculation for each individual service we deliver. Indeed, this is a calculation based on each element or each service type that we provide. The target price gap can be positive, in which case your organisation is making what we call a super profit on a particular product, or it could be negative, in which case the organisation will be making a loss on that service, or maybe breaking even and not making its margin. We will constantly return to this idea as we progress through the webinars and other materials within this Costing and Pricing Learning program. If the target price gap is positive, this is a very good thing, but it might also mean that you should go back and recheck your calculations, because the systemic underfunding of public goods in Australia means that such a result is very unlikely. If it's correct, this is a very good thing for your organisation. If the target price gap is negative, you need to examine the impact of this on your organisation and determine the best way to remedy it. If the gap is caused because you are not paid enough to cover your margin, this will have a medium-term impact on sustainability, because you may not be able to replace assets when you need to. On the other hand, if the gap is caused because your organisation is not paid enough to cover your margin and depreciation, this will likewise have a likely detrimental impact on your medium-term sustainability. However, if the gap is caused because the costs of service delivery for which the organisation pays are not covered by the income received from the funder, that is the achieved price, then you will have viability issues almost immediately, though they may not impact the organisation until working capital is consumed. Working capital is also dealt with in future webinars, but at this point in time, sufficient to say that working capital, of course, is the cash required to keep the doors open for your organisation. Therefore, all of the work that we do in costing and pricing revolves around the identification of a target price, the identification of that achieved price, and the calculation of the target price gap. Once you know the target price gap for each type of service you provide, you're in a position to start to strategize to ensure sustainability. But let's have a look at ABC costing before we go any further. ABC costing is a very important type of costing process. There are many types of costing processes used by different industries. These processes are driven by the type of industry. They're also, in some cases, driven by the tax or other arrangements that might impact those industries. In our case, we've alighted on ABC, or activity-based costing, because we believe it's the most appropriate form of costing for disability service providers. In general, we think this makes sense because all services or activities are defined fairly uniformly within the sector. They are described by funders, especially the NDIS, and the funding is provided under the NDIS on a per unit of activity provided. Therefore, when you look at your achieved price, you're looking at it on a per unit of activity or a per service provided level rather than at a whole of organisation level. And finally, ABC makes sense because the unit of analysis and consideration is the activity itself. In other words, ABC is probably the most useful and most appropriate form of costing for the types of activities undertaken by disability service providers. Additionally, though, we would argue that ABC provides a fairer and more accurate estimate of costs for each service being delivered, as well as more effective cost control, because you're able to come back to the costs of service delivery and to be able to strategize around how you might reduce or amend those costs in order to ensure that your organisation is more sustainable into the future. Further to that, there are a number of steps that you need to take into account as you approach activity-based costing. Those steps are outlined on this slide. First and foremost, of course, you need to establish appropriate policies and procedures for board approval relating to costing and pricing. This might include such things as what the board would like to have reported to it, what kind of information is required to make the board feel comfortable that the organisation is actually covering all of its costs and making a margin, and finally, what the board needs to understand in accepting budgets and looking at sustainability going forward. You need to, of course, identify all likely costs and their quantum. In other words, when we look at costing and pricing, we're looking at forecasting those costs so that we understand what costs are needing to be recovered as a result of undertaking our process. We then allocate those costs according to cost drivers. I'll come back to cost drivers and overheads shortly. However, for the moment, we need to allocate those costs according to cost drivers for overheads and directly for variable costs. We need to establish a cost per service delivery unit and establish a price per service delivery unit. That is, we need to establish how much it costs to deliver each iteration of service and what we're actually receiving for each iteration of service in order to be able to make that target price gap calculation. We then need to regularly check expected costs against actual costs. So in other words, a costing process is not a once-off process, it's an iterative process. You need to continually come back and check and recheck what your expectations were against what's actually coming out in your operations. Finally, you need to report to the board regarding the ongoing outcomes for costing and also develop any required mitigations. That is, when you can see that costs aren't being recovered or where there is a threat to your sustainability, then you need to strategize to be able to respond to that within a timely fashion. When you think about ABC costing for your organisation, you really need to make some consideration of the kinds of activities you undertake, and it might be worth listing those activities. So what is each service delivery unit and how many types of service delivery units do you have? On what basis did you determine that list? And it might be worthwhile you mapping your list of services to something like the NDIS in order to determine what kinds of services you provide as compared to what is funded by the National Disability Insurance Agency. Let's have a look at some of the fundamentals of costing then. So we've already determined that ABC costing is the best form of costing for disability service providers. In terms of the nature of costing though, it's important to understand a few fundamental concepts. Firstly, costing is forward-looking in nature. That is, that when we talk about costing and pricing, we're actually trying to forecast three fundamental things. The first thing is what number of activities we're going to provide in the coming period, what the cost of providing each of those activities will be, and what the timing of that provision of activity will be. So our ABC costing, or our costing and pricing exercise, will only be as accurate and as good as the forecasts we make. We need to predict the likely costs, and we need to do that in order to, of course, price our products, to be able to provide quotes for services, to assess the viability of a projected service, and also as a comparison against our actual outcomes. When embarking on a costing and pricing exercise, we also want to be as accurate as possible for obvious reasons. However, accuracy comes at a cost, and so we need to also consider what we call the cost-benefit rule, or the cost-benefit consideration. In order to be as accurate as we can be, we will incur accounting and other costs in arriving at the cost of service delivery. We need to ensure that we are arriving at a cost of service delivery that is accurate to our needs, but not overdone. In other words, that we haven't invested too much in being too accurate in terms of the cost benefit associated with this particular process. The cost of ABC is, of course, borne by an organisation in terms of time and money, and that cost needs to be outweighed by the value of the information developed. That is an extremely important consideration for CFOs, CEOs and others who are making decisions about costing and pricing in their organisation. Let's now turn to a few important definitions. I said earlier in this webinar that I would actually think about and talk about some of the definitions that are important to costing and pricing. And these definitions, of course, will be uniform and will help you to navigate future costing and pricing webinars and seminars, as well as the other materials. One of the things that would be well worth all participants doing is going back and having a look at the National Costing and Pricing Framework for Disability Services. That framework basically looks at the fundamentals of ABC, including the provision of a glossary of terms, which allows you to go through and look at the definitions that we use in this costing and pricing learning program to help us navigate the process of costing and pricing. It's worthwhile not only those people who haven't had much to do with costing and pricing before having a look at it, but also perhaps some seasoned accountants, because often these definitions are used in an intermixed and varied way across the sector, and it's important for everybody to know what we're talking about when you go through these seminars, webinars and other materials. As such, we think that the National Costing and Pricing Framework is mandatory reading for everyone that participates in this particular costing and pricing learning program. I don't want to go through all of the definitions because there are a lot of definitions. However, we will look at just a couple of definitions to give people a taste of the key aspects of costing and pricing, and also to help with the next phase of discussion in this webinar. As you can see, we've defined cost drivers, direct overhead costs, and the idea of allocation on this slide. Cost driver is a really important aspect of costing and pricing because it is against the cost driver, a unit of measurement of resource usage, that we look at costing and pricing, that we sheet home all of the costs and we look at the price of a particular product. Usually then a cost driver is a particular product, and it is the number of those products delivered that drives the total costs of an organisation. Direct overhead costs are also fairly important because we need to be able to split those costs that are associated with overheads and those costs that are incurred directly in terms of service provision. This is important for two reasons. Firstly, we need to understand what costs are incurred directly as a result of providing a service, so that we can make decisions about whether we continue to provide that service. But we also need to understand that overhead costs are always borne as well. The more services you provide, the less of an overhead cost that's allocated to each individual service, and then perhaps the more likely your price will be sustainable against your target price in terms of the funding provided. Allocation is also an important word, and it's a word that comes up time and again in this costing and pricing learning program. Allocation relates to how we apportion costs over activities in accordance with cost drivers. So how we apportion things like overhead costs, and how we also might allocate those variable costs that I talked about before. Some additional phrases or words that are important to understand include on-costs, which are all of those costs that are incurred of undertaking activities and are most usually understood in the context of payroll. So payroll includes on-costs such as things like superannuation, fringe benefits tax, and also other taxes and charges that might be accrued as a result of employing staff. The second phrase that I want to alight on is fixed costs. That's an extremely important element of the costing and pricing process, and it relates to those costs that are not altered by changes in the level of activity. Most organisations would have some sense of their fixed costs, and traditionally they would consider things like head office overheads, CEO and other administrative staff costs as being part of the fixed costs or overheads of the organisation. The next logical definition relates to variable overhead costs, which are those costs that are directly related to service delivery, but which increase and decrease according to the volume of activity. So in other words, there are some overhead costs that are sheeted home directly to activities, and this might include, for instance, those people who supervise the direct care provision, or those offices that are set up in order to provide services to a region or to a locality. The second element on this slide that's very important is that what we call the unit of measurement. And unit of measurement is the phrase that we've used throughout all of this costing and pricing learning program to identify one iteration of service of a particular program. So in other words, 1 hour of care service, 1 bed day, etc., etc. In fact, the unit of measurement is the basis upon which we actually provide our costing and pricing, or which we target our costing and pricing to. To build these ideas up into a pictorial diagram, you can see here that we basically divide our costs into two broad categories. They're fixed and variable costs. Obviously, fixed costs remain constant in the context of changes in activity, while variable costs vary in response to those changes. If we look at it on a graph, we can see that activity remains the same regardless of the level of, the cost remains the same regardless of the level of activity, whilst with variable costs, each new MOU, each new unit of measurement rather that has been undertaken, adds one more unit of variable cost to our cost score. Examples of fixed costs include rent and insurance, while of course direct labour is a good example of variable costs. We will come back in the next webinar to some very important rules around the idea of fixed and variable costs, particularly in the context of the relevant range, but at this point it's sufficient to identify these two types of costs and to be able to understand those. Let's now just finalise our discussion on this webinar by looking at some control considerations or governance considerations under ABC costing. First and foremost, of course, the board has a significant role in ABC costing, as it does in all aspects of an organisation's operations. Ultimately, the board, of course, is responsible for everything that occurs within the organisation and for everything that the organisation does. Therefore, the board is a great source of reasonableness checking for those estimates of costs and activity that form the basis of ABC costing. The board should also do things like set the parameters and policies related to costing, and particularly to set some of the policies around what kinds of decisions the board should make strategically and what kinds of decisions the CFO or CEO should be delegated to make in that context. And finally, of course, the board should receive reports providing the actual cost recovery versus planned or targeted cost recovery. This might mean that the board needs to have a look at things like your actual activity levels for each type of activity against your expected activity levels, and also have a look at the timing of those activities, because of course you need to make sure that all of those activities are undertaken within a time frame that allows you to recover the costs incurred in delivering those activities. Finally, financial control is also a major input from an ABC perspective, and it affects the governance arrangements as well. Financial control really means that there needs to be a regular review of the margin being achieved against that targeted, a regular review of the effects of under recovery. So you might have, for instance, one or two products, one or two services that you provide that don't recover their costs, but that's taken into consideration in terms of over recovery or more recovery in other areas. So one of the things about costing and pricing is it allows you, if you like, to make an intellectual decision about funding a particular program and not receiving full recovery of costs, as opposed to just letting that go through the keeper and not really understanding the sustainability issues for each of your organisational activities. Finally, a regular review of likely future increases is also necessary. As I mentioned in my prefatory remarks, it's very important to continually come back to the expected costs, the expected activity levels and the expected timing, and to review those expected outcomes against your actual outcomes, and to be able to develop mitigations where those outcomes are not satisfactory from a financial sustainability perspective. We'll talk more about that in the next webinar, but it's very important at this stage of the game to understand that the governance and control considerations mean that there need to be probably a change in the reporting processes, the reporting timings, and also the contents of financial and activity reports to boards and others. The next webinar then, in just wrapping up this webinar too, we'll look at more substantially at costing and pricing, look at more substantial elements of ABC, where information comes from and how that information is dealt with under the costing and pricing regime. I think at the end of the day, we will look at costing and pricing in the next webinar much more substantially and much more specifically on the cost and informational aspects of what we were doing. In the meantime, thank you very much once again for attending this webinar, and look forward to talking to you again in webinar 3.